that $1,000 a month from your pension? It is not the same as having $300,000 sitting in a brokerage account, no matter what your financial advisor's spreadsheet says. I know that comparison gets thrown around a lot. The math looks clean. You take the monthly check, you divide it by 4%, and suddenly you have a portfolio equivalent. People build entire retirement plans around that number. But there is one variable almost every version of that calculation skips. And in 2026, that variable has gotten expensive enough to change the whole picture. Let's say you are pulling $1,000 a month from your pension. If that income lands you in the 22% federal tax bracket, which it very likely does, once you stack it with Social Security, you are already down to about $780. Then, if your combined household income crosses $106,000 in 2026, you hit IRMAA. That is the Medicare surcharge most people have never heard of until the first bill shows up. Add that in, and your actual take-home from that $1,000 pension check can drop below $700. Not $1,000. $700. That gap is not a rounding error. Across a 20-year retirement, it is a six-figure miscalculation you are making before you even open your first statement. And here is the part that frustrates me most. This is not new math. These taxes exist. IRMAA exists. The system just does not remind you about them when you are sitting at the signing table. Today, we are not going to talk about generic save 15% rules. We are going to work through the actual net income math of 2026. So you know, with real numbers, whether you are ahead, behind, or somewhere in between. Let me start with something most people in pension systems have never fully thought through. Your pension is not a reward on top of your savings. It is your savings, just held somewhere else, managed by someone else, and paid out on someone else's schedule. That reframe matters more than it sounds. When financial planners talk about saving for retirement, they usually mean, what percentage of your paycheck are you setting aside each month? The standard answer you hear is 15%. But that number was built for people with no pension. If you have one, and you are still targeting 15% on top of your mandatory contributions, you may be oversaving in one bucket while leaving real gaps somewhere else. Here is how the actual math works. Most public pension systems, state employees, teachers, government workers, require mandatory contributions between 7% and 10% of your gross salary. That money leaves your paycheck before you ever see it. It does not show up in your 403B balance. It does not show up in your brokerage account. But it is working. It is accumulating. It is building the monthly income you will collect in retirement. I remember looking at my own pay stub early in my career and seeing that line item disappear every 2 weeks. The money was gone before it ever felt real. It took me a while to stop treating it as a cost and start treating it as what it actually was, a savings contribution. That shift in framing changes your whole calculation. So if you are contributing 7.5% to your state pension fund and an additional 10% to your 403B, your real savings rate is closer to 17% to 18%. For a lot of people in that situation, the 403B contributions can be pulled back, strategically, not recklessly, and redirected toward things that actually need funding. Emergency reserves, long-term care coverage, paying down debt before retirement age. Now, let's put a number on what your pension is actually worth as an asset. There is a simple way to do this. Take your expected monthly pension and run the 4% rule in reverse. If you expect $2,500 a month from your pension, divide that annual income, $30,000, by 0.04. That gives you $750,000. That is the portfolio size someone without a pension would need to generate the same income. That is real wealth. It just does not sit in an account where you can see it. But here is where the calculation gets important. That $750,000 mental portfolio does not come with a healthcare price tag already solved. According to Fidelity's 2025 data, a 65-year-old couple should plan for roughly $330,000 in out-of-pocket healthcare costs across retirement. That number is not covered by your pension. It is not covered by Medicare alone. It is a separate, significant liability that needs its own funding source, and most people are not treating it that way. So your pension covers income replacement. It does not cover healthcare inflation, long-term care, or the unexpected expenses that do not fit neatly into a monthly budget. Does your 403b or 401k have enough in it to absorb those? That is the real gap question. And that gap looks very different once you account for what you actually keep after taxes. Most retirement income projections have a quiet problem buried in them. They are built on gross numbers. Your pension estimate? Gross. Your Social Security projection? Gross. The 401k withdrawal your advisor models out? Also gross. Stack all three together on paper, and the plan looks solid. But what you actually deposit into your checking account is a different figure. And in 2026, the gap between those two numbers has widened in ways most people are not prepared for. Here is the mechanism. Pension income is taxed as ordinary income, not at capital gains rates, not at some favorable retirement rate. It goes straight onto your tax return the same way a paycheck does. So when you retire, start collecting $2,500 a month from your pension, $30,000 a year, that $30,000 gets added to your Social Security income, your 401k withdrawals, and anything else coming in. The IRS sees the total picture, not each source separately. That stacking effect is where people get surprised. Let's say your pension brings in $30,000. Your Social Security adds another $24,000. You pull $20,000 from your 401k to cover the rest of your expenses. On paper, your retirement income is $74,000. That feels manageable. But up to 85% of your Social Security becomes taxable at that income level. Your effective federal tax rate starts climbing. And if your combined income as a couple crosses $206,000 or $103,000 as an individual filing separately, you are now in IRMAA territory for Medicare Part B and Part D in 2026. That is not a penalty for doing something wrong. It is just how the thresholds work. But the dollar amounts are real. IRMAA surcharges in 2026 start at several $100s per person per month on top of your standard Medicare premium. For a couple, that can add $3,000 to $5,000 in annual healthcare costs that were never in the original budget. If you feel confused looking at a retirement tax table, that is not a math problem on your end. The interaction between pension income, Social Security taxation rules, and IRMAA thresholds involves three separate systems, each with its own phase and logic. It takes time to understand. Most people only encounter it for the first time when the bill arrives. Now, here is the trade-off that does not get said clearly enough. If your projected retirement income shows a $6,000 annual gap between what you need and what you expect to collect, that gap is probably not $6,000. Once you apply a realistic effective tax rate of 22% to 24% and factor in any IRMAA exposure, that gap could be closer to $12,000 or $15,000 in actual after-tax dollars you will need to find somewhere. That is the number worth planning around, not the gross figure. Which brings us to the decision that most people treat as a formality when they are sitting across from HR at retirement. The one you sign once, cannot change, and will live with for the rest of your life. When you sit down to file your retirement paperwork, there is usually one page that gets less attention than it deserves. It asks how you want your pension paid out. And buried in the options is a choice that looks like a gift. The 100% joint and survivor annuity. Full protection for your spouse. If you die first, they keep receiving your entire pension check for the rest of their life. It sounds like the responsible choice. The loving choice. I used to think so too. Then I watched a client sign that option, take the reduced monthly payment that came with it, and spend the next 18 years paying for a benefit his wife never ended up needing because he outlived her. That experience changed how I talk about this decision. Here is what actually happens when you select maximum survivor protection. To guarantee your spouse receives 100% of your pension after you are gone, your monthly payment gets reduced. Typically, somewhere between 10% and 25%, depending on your plan and the age difference between you and your spouse. That reduction starts immediately, on day one of retirement, and it never goes away. It is not a temporary premium. It is a permanent reduction to your income for as long as you are alive. Let's put a number on it. Say your full pension would be $3,000 a month. Choosing the 100% survivor option reduces it to $2,500. That $500 monthly difference does not sound catastrophic, but across 20 years of retirement, you will have given up $120,000 in income, paid quietly, month by month, for a guarantee you may or may not ever use. Now ask yourself, what else could $120,000 do? If that $500 a month had gone into a conservative investment account instead, even at a modest 5% average annual return, after 20 years, you are looking at a balance that could far exceed what your spouse would have collected from the survivor benefit anyway. And unlike the pension election, that account does not disappear. It can be inherited. It stays in your family either way. This is why I think of the maximum survivor benefit less as insurance and more as a high-cost, irrevocable contract with no exit clause. That framing is not meant to talk you out of protecting your spouse. It is meant to make sure you are comparing the right things before you sign. Step 1 is simple. Get a term life insurance quote before you finalize your pension election. A healthy 60-year-old can often purchase a 15 or 20-year term policy for significantly less per month than the pension reduction they are accepting. If the insurance premium is lower than the monthly pension haircut, you have just found a more flexible, cancelable way to protect your spouse, one that does not permanently reduce your retirement income. Step 2 is to look at your 401k or 403b balance honestly. If you have meaningful assets there, your spouse already has a survivorship cushion. The question is whether stacking a survivor benefit on top of that is protecting them, or just double covering a risk that is already managed. The pension election form is not a financial plan. It is a single checkbox on a single page. But it is one of the few retirement decisions that cannot be undone once the ink is dry. Do not sign it before you have stress tested what happens if the worst case does not go the way you assumed. Most people treat their pension like a guarantee, and for a long time that felt reasonable. You worked the years. You paid into the system. The number is right there in your benefit statement. Why would it change? Here is a scenario worth sitting with for a moment. Your former employer, The company or municipality that holds your pension obligation goes through a restructuring. It happens more than people expect. Corporations file for bankruptcy. Municipal budgets get renegotiated. When that happens, the Pension Benefit Guarantee Corporation steps in. The PBGC is the federal backstop for private sector pensions, and it does provide real protection. But it has a ceiling. In 2026, the PBGC maximum monthly guarantee for a 65-year-old retiree is roughly $7,200. If your pension was calculated to pay more than that, the portion above the cap is not fully protected. For most middle-income retirees, that ceiling is high enough that it never becomes an issue. But for people who spent 30 or 35 years in a well-compensated role and built up a sizable benefit, the gap between what they expected and what PBGC would actually cover can be meaningful. That is not a reason to panic. It is a reason to know your number and plan accordingly. Now add Social Security into the picture. The Social Security trustees have been consistent in their projections for several years now. If no legislative changes are made, the trust fund is expected to reach a point around 2033 where incoming payroll taxes cover only about 77% of scheduled benefits. That would mean an across-the-board reduction of roughly 23% for everyone collecting at that time. Will Congress let that happen? Probably not entirely. But probably not entirely is not a retirement plan. If you are 58 or 60 today, you will be in your late 60s or early 70s in 2033. That is not a distant hypothetical. That is your retirement window. So let's put those two risks together. If your pension gets trimmed by a PBGC event and your Social Security comes in 15% to 20% lower than projected, the gap in your monthly income does not just inconvenience you. It restructures your entire withdrawal strategy. You are pulling more from your 401k earlier than planned, which accelerates the account's depletion, which creates sequence of returns risk at exactly the wrong time. The people who navigate that scenario with the least damage are the ones who did not treat their pension and Social Security as a complete income floor. They treated those sources as the base, kept their 401k as a flexible buffer, and made sure that buffer was large enough to absorb a bad outcome from either direction. That is what the framework in the last section was pointing toward. Not fear, just optionality. So what does that actually look like in practice? Most of the advice aimed at people your age starts with a number. Save more. Catch up. Maximize everything. That framing is not wrong. It is just incomplete. The goal is not to save as much as possible. The goal is to save in the right places, in the right amounts, based on what you actually need, not what a generic rule says someone your age should have. Here are 3 concrete steps worth taking before you retire. The first is to redo your income math using net figures, not gross. Take your expected monthly pension. Subtract 22% to 24% for federal taxes. More if your state taxes pension income. Check whether your combined household income in retirement will cross the IRMAA threshold for 2026, which starts at $106,000 for individuals. If it does, build that Medicare surcharge into your monthly budget now, not later. Once you have a realistic after-tax income number, subtract it from your actual monthly expenses. That difference, not the gross gap, is what your 401k or 403b needs to cover. The second step is to look hard at your 2026 catch-up contribution options. If you are between 60 and 63 years old, Secure 2.0 introduced an enhanced catch-up contribution limit that most people are not using. In 2026, that super catch-up allows you to contribute up to $11,250 above the standard limit into your workplace retirement account. Significantly more than the standard $7,500 catch-up available to people 50 and older. If you have the cash flow to take advantage of it, even for 1 or 2 years, the compounding effect over a 15 to 20-year retirement is not trivial. The third step is to treat your survivor benefit election as a financial decision, not a paperwork formality. Before you finalize your pension option, get an actual term life insurance quote. A 20-year term policy for a healthy 60 or 62-year-old costs less than most people assume. Compare that monthly premium directly against the monthly pension reduction you would accept by choosing the maximum survivor benefit. If the insurance is cheaper, you have a more flexible, cancelable alternative. If the pension reduction is the better deal, you sign with confidence instead of obligation. 3 steps. None of them require a dramatic overhaul of your financial life. What they require is running the actual numbers, your numbers, not the ones built for an average household that may look nothing like yours. You do not need to save 15%. You need to save in the right place, at the right time, for the gap that actually exists. A pension is a powerful tool, one of the best income tools available in retirement planning, but it is not a blank check. It is taxed. It can be reduced by survivor elections. It has ceiling limits if your former employer ever faces financial trouble. And it does not automatically cover health care, long-term care, or the expenses that do not fit neatly into a monthly budget projection. None of that means your pension is fragile. It means your pension is one part of a system, and the other parts need to be built deliberately, based on what you actually keep, not what the statement says you will receive. Calculate from the net number. Make irrevocable decisions with full information. Keep your 401k flexible enough to absorb what the guaranteed income sources cannot cover. That is the whole framework. If you are sitting with a pension and trying to decide between taking a lump sum or staying with a monthly check, that decision deserves its own conversation. The math is different. The tax treatment is different. And the right answer depends on factors that a general rule cannot account for. That is exactly what we are going to work through next. Subscribe so you do not miss it. And if this video helped you see your own numbers differently, that is the point.